All right, you guys, I am Leah Applegarth, and today we're going to talk about graduated state income tax. In our last session in 2.3, we talked about state income tax, but on a percent base. It's a flat tax. But in this scenario, I happen to live in California and they have a graduated state income tax, so this is really relevant to me. And it's important as you guys grow and move around and figure out where you want to spend your lives. It's important to know how your state is calculating the taxes and if it's a valuable move for you to be there or not. Our lesson objective is to determine state taxes on a graduated income tax basis. So we're doing state tax again. When Skylar reviewed her paycheck, she realized that her state income tax was based on a percentage of her income. She wondered whether other states use the same basis or different methods. So some states have a graduated income tax. And remember, everything I highlight, you guys have to fill in on your notes. Which is a system that increases the tax rate at different levels of income. The tax sets a different rate for each of several levels of income. The tax rate increases as income increases. The tax rate on low incomes is usually 1 to 3%, and on high incomes may be as much as 10%. So our tax withheld per period is our annual tax withheld divided by the number of pay periods per year. So again, we are visiting that 52 weeks, 26 biweekly, 12 months, and 24 semi-monthly. So that's what's going to go on the bottom. So if you don't have these written down, you definitely need them as reference because they're going to be important. Alrighty. So our example, Lois's annual salary as a police officer is $34,500. She receives her pay semi-monthly or twice a month. Her exemptions total $2,000. Remember from last section, we minus out the exemptions first. That is the same as it was in 2-2. So our annual gross pay minus our exemptions. So we're only getting taxed not on $34,500, but we're getting taxed on $32,500. Now we're going to take a peek at this table. And remember, we are looking at this kind of in a thermometer type of way. So if we have a little thermometer, the first $1,000 that you make, your tax rate is 1.5%. On the next 2,000, so we're up to 3,000, the tax rate is 3%. So now we've made $3,000. In the next $2,000 you make, it's so now we're up to 5,000. We're at 4.5%. And anything over 5,000 is going to be 5%. So we're kind of filling in this little thermometer. So usually when we're attacking the table, until we run out of money, we're just going to times and equal, times, equal, times, equal, subtract, times, equal. So when we look at the process, on the first $1,000, it's 1.5%. She definitely made more than $1,000. So you are going to times 1.5% times 1,000 and get $15. On the next $2,000 she makes, it's 3%. So we go 2,000 times 3%, $60. On the next 2,000, it's 4.5%. So we're going to times that by 2,000 and it's $90. And then anything over 5,000, so we take our 32,500 minus out the $5,000 because when we see the word over, we know we have to subtract. So 32,500 minus 5,000 gives us 27,500. We times that by 5% and we get 1,375. Now we're going to add all these pieces together, 15, 60, 90, and 1375. So our grand total is going to be 1,540. We are going to use this table over and over again, so become really familiar, 15, 60, 90. We are actually not done yet. This is for the year. We are getting paid semi-monthly, so we are going to take the 1,540, divide it by 24, because we want to know how much is coming out of her paycheck. So she gets $64.17. Okay, we are going to use this little tax chart up here. Let me get my musings off of it. To do concept checks 1 and 2. So Eddie Black is single and he receives his pay bi-weekly, and just to remember, bi-weekly is 26 or every 2 weeks. His annual salary is $21,350. So he is going to get an exemption for being single. So the $21,350 minus the $2,000 for exemptions. So he is taxed on $19,350. Now we're going to rock the table. We're going to go the first $1,000 of that, he gets 1.5%. The next $2,000 of that is 3%. The next 2,000 of that is 4.5%. And anything over, so we're going to have to minus out the 5,000 because we've already taken it into consideration. So this would be 14,350. We pay 5%. Okay, so here's the good news. I know this amount. It's up in our previous problem, so I don't have to even look at my calculator because this is already calculated. The only one I have to do is 14,350 times the 5%. So $7.17.50. And we are going to total it. Bring that little buddy back. So he's going to go plus 15, plus 60, plus 90. Oh, well, that did not work out right. Plus 60, plus 90, plus 717.5. So for the year, we pay $882.50. And we need to know what it is for the paycheck. So we're adding in some skills we've been working on. So there are 26 bi-weeklies, so we're going to divide that by 26. And it's $33.94. is the tax taken out for state taxes from his paycheck. All right, let's do it again, but with this scenario. So Lydia's annual salary is $67,500. She is married, has one dependent, and is paid monthly. So let's do our exemptions first. So 67,500. We're going to minus out the exemptions, so we get 4,000 for being married and 2,000 for the dependent. So we go 67,500 minus the 4,000 minus the 2,000. And we get 61,500. Now we're going to use that to rock out our tax. So 1,000 times 1.5%, 2,000 times 3%, 2,000 times 4.5%, and anything over 5,000 So 55,500, so that's 55,500 times the 5%. Okay, so we know this is 15, this is 60, this is 90. I don't know 55,500 times 5%.
We just wanted to introduce ourselves as assistant principals today for your morning announcement. My name is Miss.
All right, so we're going to total our taxes. So it's 2,775. Oops, that's good. Plus 15 plus 60 plus 90. Total tax is $2,940. But we are not done there. We have to divide by our number of paychecks we get in a year divided by 12, and it's $245 in taxes each paycheck. All right, you guys are now scheduled to go and finish your lesson practice. Let me know if you have any questions. Thank you for participating and have an amazing day.